Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there, welcome to Better System Trader. This is episode number 144. Glad you could join us today. One of the biggest issues we have as systematic and algorithmic traders is that the markets are dynamic and constantly changing. However, it's quite common to build trading strategies that are static and are really designed to take advantage of an optimal set of conditions which don't actually last very long, if at all. Now, this can cause periods of good and poor performance as trading strategies fall in and out of sync with the markets. So it kind of makes logical sense to try including some adaptive elements into trading strategies to help them adjust better to the markets as they change. Our guest for this episode is Jane Fox, also known as Trader Janie. Jane runs the website QuantiTrader and is here to share some of the techniques she uses to add dynamic abilities to her trading strategies. Plus, we discuss some other important topics as well, including the top 3 components of trading strategies and how adding adaptability to these components can improve a trading strategy. Jane also shares why static stop losses could be hurting your trading performance and some techniques that she uses to overcome these issues. We also discuss how a circuit breaker can save your trading account when things get ugly. And we'll talk about dynamic position sizing techniques that Jane uses to increase returns while also reducing drawdowns. Plus, we go through a whole lot more as well. So let's get started now with my chat with Trader Janie. Hi Jane, welcome to the show. It's great to have you here.
Hi Andrew, how are you?
I'm great, thank you. So do you want to just start by perhaps giving us a little bit of your background, tell us a little bit about yourself and how you got started in the markets?
Sure. My monk here is Trader Janie, and I kind of got that from Trader Joe's. There's a store that's called Trader Joe's, and so I thought that was pretty cool, Trader Janie. So back in 1999, I was working for a help desk and in an IT department. And I just decided that it was time for me to kind of go out on my own, and I started trading, and I went through options, I went through futures, I went through Forex, I went through them all. Finally came to the realization that it was actually stocks that I needed to start trading in, and I thought, well, where do I go? And I found a fellow by the name of Larry Connors, and I'm sure everybody has heard of called the Connors RSI. And I thought that I really liked what he had to say. He did swing trading. He held for 2 or 3 days. He didn't use a stop loss. He uses what they call dynamic exits. And it was just something that I really felt that it really talked to me. So I decided that I was going to take some courses with him, and I took about 3 or 4, and still I really wasn't feeling, where I needed to go with it. So I ended up taking a weekend course, and I actually got the code from one of his strategies because he used algorithms, and I knew this was something that I needed to do. Plan your trade and trade your plan is that I needed a plan in order to trade. So I found the actual code that Larry had for one of his algorithms, and I plugged that into OmniBroker. I started using NPD data from Australia, and I started to realize I thought that I was just like, this is it. I'm going to be a millionaire next month. Come to realize that there was a little bit more to developing an algorithm than just plugging in some code. So I took that code and I started working with it. And I was a programmer in my previous lifetime, and I thought, well, I could probably do this. And then I started realizing that, I could either learn the code or I could learn the business. And I decided that I was going to learn the business and I was going to give the coding to actually somebody else. I got to the point with this one fellow, and he said that some of the some of the ideas that I had, he didn't know how to code them. So he said, well, why don't you try to find this fellow by the name of Bruce Robinson? And so I found Bruce, and he was actually doing work for hedge funds. And I thought, well, there's no way that this guy's going to talk to me. But I found him at a time when he didn't have an awful lot to do.
Wow.
So he said, yeah, I'll take you on. Well, that was, let's see, this is 2008. That was 5 years ago. Bruce and I have been working hand in hand now for 5 years. And my business is what it is basically because of all of the ideas that he has given me. And so anyways, I took this code that Larry gave me, and I built one of my first algorithms, and realized, and I started trading it. And from that point, then I started to recognize that I needed to put this in. I needed to put like a circuit breaker in. I needed to put position sizing in. I needed to do dynamic exits. And so over the years, I have implemented all of these really cool features that I don't think very many other services have. But that is, and I opened my doors in December 16th, the day after my birthday on 2013. So been in business for almost 5 years now. Well, 4.5 years, I guess. Yeah, it's cool.
Cool. So you mentioned there a couple of different aspects to trading, some really cool things that you've implemented. You mentioned dynamic exits and circuit breakers and things like that. Do you think that there is any one particular aspect of trading strategies that is more important than the others, or have you focused on any one particular component more than others?
Hey, Andrew, there's three. The first one is the stop losses. The second one is the circuit breaker, and the other one is position sizing. The first one is like with the stop losses, and so many people, I have written so many blog articles on that. If you don't have a stop loss, you should. What the very first thing you have to do is you have to put your stop loss on. And there's some adages that you hear in the stock market that are not. Well, not that they're not true, but they're not tested, and people just take them as verbatim. There was a quote that I found probably 4 years ago, and it was a market maker. And he said, we big boys are taking all the suckers that are sitting in the corner with their thumbs in their mouth and all worried that their trade is going to get stopped out. Then I come along and bam, take those stops out and all the momentum take off as I start collecting cheddar. This was an actual quote from a market maker because he was going after stop losses. You put your stop loss in, they're going to come get you. So what you do is you use what they call a dynamic stop loss. It is something that is based on an indicator. My stop losses are based on the Connors RSI. When the Connors RSI hits a certain level, that's when we leave. That's when we get out. So that's what we call like a dynamic stop loss. And so it's not a set stop loss. There's no way that I have stop losses sitting out there so they can come get me. Yeah. I have a stop loss set for the next day.
Yeah. So I think we might get into that dynamic exit a bit more in a minute, but I'm just thinking about your comments about stops, and I can think there's a couple of studies that come to the top of my mind about the impact of stops on the performance of strategies, like the Connors and Cesar Alvarez have released some info on that. Has there been anything in particular that kind of, well, other than that quote from that market maker, but has there been anything in particular that really caught your attention and solidified your opinion on stop losses?
Well, once again, I don't take anything verbatim. If I can't prove it, I don't believe it. So if somebody tells me that stop losses are going to hurt my performance, I have to go prove it. Yep. And I have the capability to do it because I use OmniBroker. I can go and test anything that I want to. And that is what I did when I started looking at this, and when I started recognizing that stop losses are probably the way to go. I thought, I need to prove it to me. I need to prove it not only to me, but I need to prove it to my members. So I did. I literally, Andrew, have run thousands of optimizations, and a lot of them are stop losses. And what you do is you put a stop loss in, okay, stop at 1%, 2%, 3%, 4%, 5%, and then you just let it churn out. Like sometimes my optimizations take 24 hours. But When I come back and I recognize that my stop loss, the best stop loss is like at 50%, I'm kind of going, okay, no, it's time to say no. Stop losses are of no value whatsoever.
Yeah.
So,
yeah.
I mean, I mean, you have to have a stop loss, but it's a dynamic stop loss. It's not a set stop loss that you are going to put in the market that lets somebody see that it's there.
Yeah. So you mentioned that you use the Connors RSI as an exit technique. What other types of indicators or techniques have you tested that show some kind of merit?
Well, I use the Connors RSI for my stop losses exclusively. All of my strategies use that. That's 100%. And I have found I have tried just using a moving average. I have tried MACD. I have tried stochastics. I have tried them all. And and just regular RSI. I have tried a regular, like a 2-day RSI. But I have found that the Connors RSI has absolutely given me the best performance. And like I said, I can test this. I can go back and I can say without a doubt, I have proved that this particular stop loss and this particular strategy is the best because I have got all of the optimizations and all of the tests that substantiate that.
Yeah. So what is it actually about the Connors RSI that makes it better than these other techniques like the traditional RSI that you mentioned? What's the difference there?
That's a good point. The Connors RSI has 3 different components to it, and it probably get a little bit too much to get into it on here. But you could probably go back into my website and you could type in Connors RSI or just Google Connors RSI, and it will give you the formula that I use to create the Connors RSI. It takes, like I said, 3 different components to, and it makes the Connors, it makes an RSI just one level better.
Yeah. So do you try and match, because you mentioned you do some swing trading and the Connors RSI works quite well for exits. Do you try and match the exit with the entry condition as well? Do you think there needs to be some kind of synergy there, or how do you look at exits compared to entries?
No. The entries are based on a set of parameters. And the point here is that we may put in, it's like getting into position sizing, and we'll get into that probably next. But let's say one of my strategies allows 10 positions. We may put on 10 trades. The next day, it's possible only 3 of them are filled. So then the next day after that, we put on another 7 positions, and then maybe only 3 are filled. So the Connors RSI plays a part in how we are filled. But once we are filled, once a position is open, either short or long, then it is 100% based on the Connors RSI to get out. Of course, the Connors RSI have to be low or high based on if you're long or short.
Yeah.
Does that make sense?
Yeah, totally. Yeah. So if you're using a dynamic exit like this, how do you judge the risk on the trade, and how do you protect the capital without having I guess you could call it a static stop loss?
Well, that is all part of the metrics that I get from OmniBroker. When I run a test or when I run an optimization on OmniBroker, it gives me the profit factor, it gives me the standard deviation, and so it gives me all of the metrics that I need to determine that particular set of parameters is absolutely the best for those rules.
Right, okay. So there are other metrics in performance reports as well, like maximum adverse excursion, which some people use to kind of judge the average risk on a trade. Do you use those type of things as well?
I certainly I don't use them as one of my metrics, but I definitely look at it when I decide that there is a set of parameters that I am going to use. The maximum adverse excursion it measures the largest loss suffered by a single trade while it's open. And you have to admit that when you are going through a trade, this kind of a metric is very, very important. It's kind of like the max drawdown. If you're going to go to a max drawdown of 40%, you have to realize that your members are going to have to live through this. Maybe your max drawdown is just going to be a one-time event, but you have to realize that your members are going to be going through this. And so when you're looking at an MAE, you have to know that if you are suffering a loss from a single trade that is like 74%, that's going to hurt. That's going to hurt. The thing is, though, like today, it's very possible that there were a lot of trades that suffered quite a bit. But then eventually they went down, they came back up again, and like tomorrow may be just another day altogether.
Yeah. So you're just talking about selecting the parameters that you'll use for trading. Do you ever kind of adjust or tweak those parameters based on additional factors, like perhaps changes in market conditions or reoptimizations? Like, how do you manage those parameter values over time?
Oh, Andrew, yeah, I do once a month. I do what is called I call sensitivity analysis, and it's like Howard Bandy says that every strategy is going to fail at some point. Every strategy, and the way I like to reword this, every strategy is going to get out of sync with the market. And it may get back into sync, it may not. But when it's out of sync with the market, you want to make sure that you put yourself into cash and that you're not trading through it. So when I do my optimizations, I look back on what Howard Bandy calls objective functions. And I categorize all of those on every one of my strategies. I'll run my optimizations on I've got 13 different strategies, and I will then determine on how to adjust them. And I really don't have to do an awful lot of adjustments. And I know in this last month or so, I've done a few more than I have ever done for the last 4 years, because the environment absolutely is changing now, and I can recognize that from my optimizations and how I'm having to change my parameters. But those parameters have to be adjusted on a regular basis because the environment is changing at all times.
Yeah. Yeah. Another quote, I think it was from Howard Bandy, one that I like, is that, I'm going to paraphrase it here, I probably got the wording wrong. The correct position size for a strategy that's broken is 0. And, early in our chat, you mentioned the term circuit breaker, which I assume is kind of, knowing when to switch a trading strategy off, which can be challenging because how do you determine if the strategy is just broken completely, or perhaps it's going through a bit of a rough patch and it might recover? So how do you approach this issue?
That's a really good question. And Andrew, I wish that more people would ask me that question. I really do.
It's really important. That's a tough one.
It's so important. I don't care if a strategy is completely out of sync with the market or the strategy's broken. All I know is I'm going to get out. I have what you like an equity curve of each one of my strategies. And my circuit breaker is as simple as a moving average on that equity curve. Now, my moving average on each equity curve is a little different because each equity curve has got its own personalities. So I may have a 200-day moving average on one of maybe the Ultra, maybe I've got a 150-day moving average on the S&P margin, but every one of them has a moving average. And soon as the equity curve of the strategy falls below that moving average, I'm out. I put the strategy what I call on probation, and it will stay on probation until it moves back up above the moving average. Now, the question, I'm sure the question that you may have, and maybe some of the listeners may have, is like, well, what happens if it comes above the moving average and then moves right back down again? And I know over time, I have been doing these for such a long time that I know when that strategy is going to be coming back and when it's not. And I can calibrate my moving average to the point where my circuit breakers work absolutely wonderfully. And I have got 3 strategies right now that are under the circuit breaker, but are just about ready to pop up above it. And we're sitting in cash, and it doesn't matter if the strategy comes completely out of sync with the market or if the strategy falls off the face of the earth, because we're in cash and we're not trading it.
Yeah. Yeah, you read my mind. That was going to be my next question about being whipsawed with using a moving average on an equity curve. So do you optimize the length of the moving average? Because you mentioned there that strategies have different personalities. So some probably want a longer moving average than others. How do you determine what the length is?
That's a good question. And to tell you the truth, I've never been asked that question, but I do. I definitely do, because strategies change over time. Yeah. It's like the ultra strategy, it does small cap and large cap, and it had one of those in last October, December, so it was kind of going up and down again. It never did fall under the circuit breaker, but then it just started to actually take off. So I have had to recalibrate the MA, or the moving average, or the circuit breaker on that particular strategy to it's much less than it was before, because I had to give it a wide berth when it was doing a lot of the whipsawing. And now that it's on a trajectory that's basically straight up, I'm having to make it much smaller, because I want to make sure, because I know that when something is moving straight up like that, it is going to have a period of time where it's going to have to consolidate. And I want my members to be in cash while it's consolidating. I don't want my members having to trade it.
Yeah. Yeah, that's a great point. Okay, so we've covered 2 of the 3 important aspects that you mentioned at the top there. We've got stop losses, circuit breaker. I think the third one was position sizing. So obviously it's incredibly important for traders, especially if you're not using, I guess, a fixed stop in the traditional application as a static price, but rather using a dynamic exit. So what's your approach to position sizing?
There are, when we started the interview, I was talking about that. I used Larry Connors, and I really believe that he did some awesome work. But there were 2 aspects that he never approached. Number 1 was the circuit breaker, which was already talked about, and number 2, it was position sizing. He basically let all of his members decide their own position sizing. I don't. My position sizing is based on the size of your account. If you've got a $20,000, $25,000 account, you're buying X number of shares. If you've got a $200,000 account, you're buying Y number of shares. And the way that I work this is I have what we call large positions and small positions. And all of the trades all the candidates that adhere to my parameters are sorted on the 100-day historical volatility, because there is research has shown over and over again that volatility is the best way to trade. So say I have got 20 candidates, I will sort them on historical volatility. The ones with the highest volatility will get what they call a large size trade.
Right.
Then maybe I've got 6 of those, and then I've got 4 of the small. And each large is given what they call a large factor. Maybe it's 1.2, 1.1. So they get a larger size of the account than the small ones do. So I have got large and small, and I have got a percentage, and my website shows you exactly as to what percentage of your account goes to each one of the trades. So you don't have to worry about it at all. So if you've got 10 positions that you are looking at in a strategy, and number 1 could have 12%. And it would say 12% of your account. And then I've got a calculator. So you put in, if you're trading $50,000, you put in $50,000, 12%, and it tells you exactly the number of shares to trade for that particular position. So there's no guessing at all.
Yeah. That's a smart way to do position sizing, I think, ranking by adjusting based on particular factors like the historical volatility. Have you looked at any other factors to ranking to see how they impact performance?
That's a good question too, but no, I have not. Larry Connor's used a 100-day historical volatility, and um, I've kind of played around with maybe different kind of indicators, but that was when I was just first getting started. But no, I have not looked at any other indicators to determine position sizing or the ranking on positions.
Yeah.
That might be something that I need to start looking at.
Yeah. So how much of an improvement to performance does this actually make by doing this dynamic position sizing?
I have seen my Ultra portfolio that started out with, I have never used absolute. I have never used this like I've got 10 positions, each position is 10%. I never started out that way. I started out with this position sizing right from the get-go. But I have optimized that over the years as well. And my Ultra strategy went from around 35% up to, I think it was like 43%. So it was almost 6 to 7% improvement in performance with position sizing. But the thing is, though, not only did my compounded annual return go up, the huge part about this is that my max drawdown actually went down. Now that was, so many people talk about profit, but you also have to think about the max drawdown, and not only the max drawdown, but the average length of your drawdowns and whatnot. So not only did my profit go up, but my max drawdown went down.
So you're picking a better quality of trade and putting
so
more
much
money
better.
behind it. Yeah.
So much better. So much better.
Okay, so I just want to ask you one more question before we start wrapping up for today. Now, I know that there are some listeners who offer services and signal services to other traders as well. So I think one of the challenges with that is trying to manage subscriber expectations or trading expectations. How do you kind of approach that? Because that can be a really tricky thing, especially when they're going through drawdowns, or as you mentioned, when you've got a strategy and a circuit breaker which isn't making any trades, people are paying you for that service. How do you kind of manage all those things around trading expectations?
I try to make sure that I give them, my potential members, my current members, as much information as I possibly can. I not only talk about max drawdown. Max drawdown is a good number to know, but seriously, when I have had strategies that have got like a 40% max drawdown, but it goes smack down, it goes straight back up again. So max drawdown is important, but there's also many other things like average drawdown and drawdown duration. Drawdown duration is how long you've been in a drawdown. You may go into a max drawdown of 40%, it comes right back up again. Well, big deal, But if you've got a max drawdown that's only 18%, but it lasts for 2 years, there's no way. There's no way that you are going to be able to live through a strategy that has been in a drawdown for 2 years, not making any new equity highs. So there's so much more to the metrics that you just can't look at profit, and you just can't look at max drawdown. There's so many more things that you need to look at. And I have gotten to be extremely good at identifying equity curves. I mean, I can look at equity curves and I can get chills down my back sometimes when I look at equity curves. And I know about this over the years. I have learned what it's like to, look at an equity curve and think that, yeah, wow, this is really something. And so I try to relay this to my members. Plus, also, I write a weekly newsletter every Sunday, and I try to talk about trader psychology, and definitely the newsletter that's going to be going out this Sunday is going to be talking about what the market's doing in the last little while, because I know that a lot of my members, a lot of potential members, are probably just totally running scared. As a matter of fact, I put a a message up on Facebook today, and I said, please do not look at your 401k statements tonight. So, it's managing expectations, Andrew, is probably got to be one of the most important things with a service like mine, because I am an active trader. It's like I am probably just one step above day trading, because we do 30 to 40 trades every month on a strategy. And if you don't want to put the 15 minutes in a night, if you don't want to put that many trades on, then maybe that's my service is not for you. But if you really like trading, if you just love the whole world of trading, that's where QuantiTrader really shines. But making sure that you let your members know that this is the kind of person that you are. The person that QuantiTrader is we're active traders. We do a lot of trading. It is in your life. It's part of your life. And you have to know that unless you can take a drawdown of like 20% or whatever, it's not for you. But if you can really live through that, then yeah. And if you want to have like 43% compounded annual return, then that's the kind of stuff you're going to have to live through. So managing expectations is extremely important. And I am available to my members at all times. Well, not in the middle of the night, but you can send me an email, and if you ask me to call you, I will call you, and we will have a phone conversation. So I am available at any time.
Okay, cool. Yeah, you make some really good points there about managing expectations, and even if you're doing your own trading, it's incredibly important to have the right expectations starting out. So thanks for mentioning that. And that was also I think the second time you've alluded to something happening in the US markets overnight. So it's early morning here. I haven't had a chance to see what happened. So I'm looking forward to opening my trading account and seeing if there's any damage. It's going to be a nice little surprise.
Well, the Dow went down 724 points today.
Okay.
Hopefully you were short something.
Yeah, I think that's actually a good thing. One of the benefits of living in Australia is you don't see all the stuff that happens overnight. So assuming your strategies are built to cope for that kind of thing, it's probably it can be a blessing at times. So anyway, we'll see what I think when I look at the results.
One point that I'd like to make, Andrew, is that it's like, okay, the Dow went down 700 points today, but you know what? It's done this before. And the strategy that you have, the plan that you have, how well did it do when it was in October 2008? How well did your strategy live through that year? My strategies in 2008, quite a few of them were over 100% compounded annual return.
Yeah.
Because they just thrive. They thrive on this kind of volatility. Yeah. But you have to have the mindset for it. You have to be able to live through it. You have to be able to live through the Dow going down 700 points. And it's very possible it's going to go up 700 points tomorrow. It's you never know. You just never know. And you have to be able to have a plan. You have to have a strategy that that is going to be able to survive times like we're going through right now.
Yeah, definitely interesting times. Okay, so I'd just like to start wrapping up now with some quick closing questions. The first one, what's the biggest lesson you've learned through trading?
Oh, absolutely. You need a plan. You need an algorithm. You need to be able to test whatever it is that you're trading. If you don't test what you're trading, you don't know what you're No, you don't know what you're doing. No. I know. I'm not going to say that, because there are some really good intuitive traders. I'm not an intuitive trader. I'm a mechanical trader. I'm the kind of trader that needs the computer to tell me what to do, because otherwise the thing that's in between my ears gets in my way.
Yeah, absolutely. What is the best trading advice you ever received?
Plan your trade and trade your plan.
Okay, I'm sensing a theme running here.
Yeah. my trading. Yes, for sure.
Yeah. Okay. How about favorite trading books?
Oh, without a doubt, Mark Douglas, Trading in the Zone. Seriously, Andrew, that changed my life. And I am not being. That's not a hyperbole. It changed my trading life. I read that book, and I knew that I had come to a point. It's called a significant emotional event, an SEE. And Trading in the Zone by Mark Douglas was my SEE because it told me exactly what I needed. I need to be a mechanical kind of trader, but then I needed to go out and find the mechanical plan. And that's where Larry Connors came in. But Mark Douglas, Trading in the Zone, without a doubt, every trader should read that at least once. I've read it 20 times.
Yeah, I think there's a handful of trading books that you probably need to revisit every now and then because you can forget some of the principles of trading. And I think that's probably in the list there. It's a good one to read. And I think especially for algorithmic and systematic trading, people kind of think that you're not going to struggle with the trading or the psychological aspects of trading because you're leaving it up to an algorithm, but I don't think that's actually the case. I think even when we're letting computers do the trading for us, we're still susceptible to some of those kind of issues.
Oh, yes. I mean, when I first started trading, I thought psychology was 70% of it. Over the years, I've gone to 80, maybe 90% now. I mean, it's just amazing that if you can stick to a plan without the emotion behind it, you have arrived. Yeah. I've not gotten there yet. I still get emotional when I see days like this, and I have to go check I check my 401ks, you know. Yeah.
All right. Okay. So what about the best way for listeners to get in touch with you or to learn more from you?
Well, if you go to my website, www.quantitrader, quantitrader.com, you can sign up for my newsletter, and you will get my newsletter next Sunday. And I also have a 30-day free trial for my strategies as well. That would be an excellent way to test me out.
Yeah. Okay, cool. I'll have a link to your website on the page with this interview so that people can find it. If they're listening in the car and they missed that website, then it's just there on the page. So they'll be able to find that. So thanks a lot for your time today, Jane. It's been really great chatting to you. It's been a lot of fun. Is there anything else that you'd like to mention before we finish up?
I would just want to say thank you very much for this opportunity, Andrew. It's been it's awesome talking to you. Really, really enjoyed it.
And likewise. So thanks again, and I wish you all the best.
Thank you very much.
Okay, bye.
Take care.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.